All right, let's get started. Hope everybody can hear me. We're missing a lot of students, but we'll go ahead because it's an important week. I gotta get ready for the next paper. So you have a paper due on Friday. If you're a little late, not a big deal. I doubt I'll grade more than 4 or 5 of them on Friday anyway. And then Saturday, I have all day to grade, and Sunday. Your risk that if you're late, my goal is if I get papers on Friday, I'll have them graded by Tuesday. Your risk that if you're late, I won't get it graded by Tuesday. So that's your risk. If you're much later than, say, Saturday at 2 or 3 in the afternoon, I'll probably ride my bike all morning. So I'll probably try to grade about 5 of them on Friday and probably 15 of them on Saturday and 15 on Sunday, maybe 10 on Monday. So I'll get the whole class done over those 4 days. Maybe you have to push a few of them in the Tuesday. But if you're really late, and the worst thing about being late is it just gives you less time to do the next papers. So remember, I'll let you resubmit. So if you have an area that you're not quite where you think it should be, but you want to see where you are, get it turned in, and then you can resubmit later. I'm curious. I assume they're going to do an instructor survey this year, so I'm really curious what we did last week. First of all, we had almost everybody made it. My requirement is that everybody come, but we had all but 2 students were there. I thought it was valuable to me because I could see where you were a week going in. I also think, you can tell me, I also think having that pre-workshop forced some students to get further along than they would have been if we hadn't have done it. And I think that's valuable. I know I'm getting that feedback in my other class. I required them to do a draft. So it counts toward your participation in the class, but it also, I think, helps. But I'm actually thinking, this is where I want feedback. I think there's some things we might try this semester that we should keep doing even when we're back on campus. To like cancel classes and instead have smaller Zoom sessions with smaller groups. But you also give me feedback on that. When the instructor survey probably won't be until November or sometime. But it was helpful for me to see where y'all were. Several of y'all were pretty far along, so I was amazed. Some were not very far along. But there's always procrastinators in this business. It doesn't mean you can't do this job. It just means you're gonna have to figure it out in a different way. And I know I have one student who turned papers in late, but his finals papers were exceptional. And I don't think he's procrastinating as much as that the way he did his work and spread it out over time. It just things showed up at a different time. I got an email from him today. He's on the sell side. He's doing very, very well. He's getting great reviews from his bosses. So somehow he's figured out how to get it to work. He was never really late on his papers, but he might be late a week or 2, but what he turned in was exceptional. The downside for that is my grading schedule. I get off my grading schedule. I think you're better off getting it done on time. Any feedback on what we did last week? There's just something we should do different because I want to try the same thing again for papers 3, 4, and 5. 3, 4, and 5.
I think it was actually a great idea what we did because it gave us one-on-one time with you, and it allowed you to essentially provide, how should I say it, personalized feedback on each of our papers as compared to the broad strokes of what would have happened if you had just reviewed it in class or something like that.
All right. Yeah, good. And I think I might actually create a couple extra groups. There's one group, the one with ATVI in it, and one that had like 6 industries in it. I might break that one up a little bit more because, yeah, I like the groups where we just had 2 or 3 or 4 students. Those we could do a whole lot more with a fewer students. So I'll maybe break it up. So well, give me feedback if you want to give me feedback through email or a call or even anonymously or whatever. This is your class. This is all about you. This isn't about me. So we've got to do it in a way that gets you where you need to be. All right. So let's talk. Where we're going next is we're going to start talking about papers 3, 4, and 5. I know you're still working on 1 and 2, so it's a little hard to get there. You won't start on these papers until after Friday. but let's talk about it. So paper 3 is not a particularly gruesome paper. It's about maybe 60%, 70% of the workload for paper 1, and some of the stuff you did for paper 1 can probably feed over into this. Let's look at the rubric first, just so we know what we're talking about with paper 3. So the thought here, that what we're doing is essentially what you would do in a real-life cell-size job. So your papers 1 and 2, you're initiating coverage of an industry. You're not particularly talking about any one particular company. You're doing an industry, so you might talk about companies because they're leaders. That's papers 1 and 2. Usually after you initiate on an industry, you then do company-specific papers. And so you're only going to do one company out of your industry, but we'll go through the full-blown. I'm doing, if you're in the investment society, I'm going to do a career class for the investment society, probably Mondays at 6:30. One of the students is on the sell side. Another one has just agreed that he's going to come help talk to the students. He started on the sell side. He's on the buy side now. I might show you what work he did at Goldman Sachs. It was really quite fascinating. But he did an initiation report on the healthcare industry. Very thick books, so you know these are very intense. He was doing exactly what you're doing for this paper, so it's an incredibly good experience. But if you're in the investment society and want to sit in that class, then you might find his discussion really quite helpful. One of our students is still on the sell side. He's been there about a year. And he can give you, since we're doing a sell side report, he can give you that background. And I've got a few others. I got some on the corporate side. I have one that's doing venture capital. So to give you some lay of the land, the venture capital guys are not radically different than what we're doing. It's just that they tend not to write long papers. So, so that's the process. We're very sell side focused here. So now you're going to get into the company. Just talk about the industry. Part of what you want to do in paper 3 is tie your company back to all the industry research you just did. Where does it fit in this industry? So you need a description of your company. It needs to be very understandable, so don't use jargon. I had one student write in this class, and boy, I told him, there's no way you understand what you just wrote. And it was sure enough, he found a very technical article, and he essentially copied and pasted out of there, and I could just tell there was just no way. It was way too technical. Some of you are doing very, very technical companies, so try your best to put it in layman's terms. If you don't understand it, then don't put it in your paper. Don't put a sentence in that you have no idea what it says. Do your best to try to understand it. So definitely you want to talk, what products does it offer? And again, here's where you want to tie back to paper 1 when you talk about the sub-industries. Where does your firm fit in? Someone was asking me about Lululemon, and they said, okay, we're doing sports apparel, but should I break out shoes as a separate category because Lululemon doesn't do shoes? Well, that's fine. In paper 1, you may have a subcategory that your company doesn't do at all. Those of you doing like NVIDIA and Texas Instruments, you have subcategories on semiconductors where your company doesn't do that at all. There's a lot of things NVIDIA doesn't do. That's fine that that's in paper 1, but then when you get to paper 3, you want to say, okay, now I'm doing NVIDIA. They fit in this part of the industry I just discussed in paper 1. So it ties right back. So what are their main products? You don't have to necessarily talk about all of their products. If you're doing a Microsoft or an Apple, and I don't think we have any Microsofts or Apples. We had one Apple, and he changed his mind mainly because it's such a complicated, so many products. But what products are they in? The majority try to get at least 80% of it. Think about their customer base. What is their customer base? This again is where you tie it back to paper 1 or that differentiation strategy. Where's their primary market? Are they national? Are they focus? Are they international? You know, you talk about a Chevron and Exxon, definitely global companies. You look at BJ's restaurant, which one of y'all was doing. That's a very U.S. and probably very regional. Delta Airlines is a national carrier, but there's a lot of regional carriers. So who's the customer base? What's the geography? What is your market share of this firm? Is it growing? Is it shrinking? Is it changing in some way? When you talk about the customer base, you know, tie back to paper 1. is this a growing customer base or a shrinking customer base? So if they're expanding overseas, then it's a growing customer base just because they're growing overseas. If it's a growing customer base because it's a new product, maybe the Apple Watch fits into this category. It's a new product. It's still got a lot of room to grow. Or is it a saturated product? Some history of the company, again, don't get carried away. So in fact, sometimes I've seen students do a chart, like a timeline on the history. That's far better. Major mergers and acquisitions like Exxon buying Mobil would be very, very helpful. Spin-offs like Valero selling off Corner Store would really, really helpful. If the firm has changed dramatically, someone's doing Netflix. So obviously Netflix, they started off mailing CDs and now they're digital and now they're in production. That transition is really, really critical. I don't need you to go back, Procter and Gamble in 1827 and they were doing whatever, it's that you're focused on growth and earnings. So, for Netflix talking about going from CDs to digital to production, this is a firm that keeps reinventing itself. So it's going to get the person reading the analysis, well, what's the next big thing they're going to do? Have they come to the end? Is there nothing else brand new for Netflix to do now that they're doing digital and doing their own production? Or is there going to be another major change? This firm has reinvented itself dramatically 3 times now. What will be the next step? And then other attributes, a lot of times the culture of the firm is a good thing to talk about. You might be able to Google that. The culture of ATVI, the culture of NVIDIA, the culture of Texas Instruments, and see what comes up and what people are saying about your company. If you look at the student example, I was just looking at NVIDIA today. I thought he did a really good job of explaining the company, the different products. If you have more than one product, you may have to do these things more than once, or at least these 3 things: the customer, the geography, and market share. You may have to do them more than once to explain the company and its products. But there are some really good, I think actually, it's a little tough with papers 1 and 2 because I've become much more strict on the Porter's analysis than prior papers have shown. But paper 3 should be good examples of how to build a paper 3. And really, and I think most students did a very, very good job on paper 3. The next part is the tough part. You got to decide on management. How are you going to cover management? One thing I don't want you to do, if you look at prior papers did not do this well, so don't use them as a guide. One thing I don't want you to do is go to the annual report, copy and paste a bunch of biographies. I don't really care what their landscaper where they went to school. You definitely need to talk about the CEO, maybe the CFO, but think of it more strategically. Where did the CEO come from? Has she been there for 50 years, or did she just start last year? Did she come from inside the firm, or did she come from outside the firm? One thing I really find important, let's take Exxon or Valero. Is the CEO a Harvard business grad, or is the CEO a petroleum engineer? For me, for really technical firms like energy, like ATVI, like NVIDIA, Texas Instruments, I like CEOs that have degrees in the most technical part of the business, whether they're computer people or they're energy people or whatever. I like them to have that kind of background, maybe even at Disney a little bit. Other firms, especially retail, I don't mind a retail CEO not having a retail background. A good example of this is Hewlett-Packard, and I can't remember the lady's name. I don't remember. It's Whitman or Whitmore, but they hired a CEO outside of the computer industry. She did not have a technical background, but she had a really strong retail background. I thought that was a mistake because you're in such a technical field. If your CEO doesn't have a background in that technical field, I think it may be dangerous. It's a big question how good of a job she did or not. But that's one thing to think about. The technical background is the boss a Harvard grad finance background person, or is it someone who's grown up in this industry and knows it backwards and forwards? And sometimes I think it's better to have one versus the other. It's also very important if it's an internal candidate or external candidate. Internal candidates know the company extremely well, but also tends to be stuck in their ways and may have a tough time moving the company. That's why firms that are in trouble often are outsiders. They come in and fix the company. You have interesting companies like an AIG where you had 2 CEOs over 70 years. That's pretty rare. But talk about management. We'll talk about what's not in here, and I should have put it in here. And that is the ESG. We'll talk about ESG in the class notes. But I don't know if y'all know what ESG is. Anyone remember? If y'all had that in another class? You may know what the E stands for. No,
Is it environment, social, governance?
Very good. Environmental, social, and what did you say the last one was?
Governance.
Governance, yeah.
Would this be like, making sure our externalities are like a part of the environment, making sure we can take care of it and stuff like that?
Yeah, I mean, it's becoming a bigger issue because you're having more activist shareholders. Maybe it's CalPERS in California, where you have a pension plan for the state, which is huge, billions of dollars, and they vote on environmental things. They vote boards to change environmental things. If you're doing Valero and Exxon and Chevron, the environmental side is huge. There was an excellent Economist article talking about who's going to win and lose in the next 20 years when it comes to environmental issues. How much are consumers going to turn? We have a new president coming in that could actually start doing more carbon pricing. So the environmental side, so far, it doesn't seem to have had a huge impact on how firms behave. But obviously, Tesla has a huge advantage there with EVs. On social, it's just like everything else besides environmental. It's your hiring practices. It's how you treat the community. It's how involved, those kind of things. Governance is something, these have not been big issues in previous papers. I remember Dr. Miser, my favorite professor at UTSA, really great guy. Unfortunately, he retired here a couple years ago. He said we need to be doing much more governance in our papers. It's a real weakness, and he's a sharp guy. That's not my thing. I didn't do a lot of thinking about governance when I was a security analyst. I probably should have. It wasn't that big of an issue back then. Bloomberg does have an ESG function, and you can find ESG function. Anybody know that Capital IQ has an ESG function? Has anyone looked into that? You might try it. You could also try ESG and your company name in Google and just see what happens. They should have an ESG discussion in your annual report. Some people roll their eyes, on global warming, our firms just giving lip service to it and then not doing anything about it. That seems to be, I don't know if y'all saw all these firms that signed up to the ESG, stakeholder kind of thing. It's interesting, the economist said the firms that signed up to that have actually done worse than the firms that didn't when it comes to ESG. So it looked like it was more lip service than anything else. But it's probably going to become a bigger issue. Governance has always been important, and we'll talk about that more when I get to the class notes. The ES, you have to decide on that. I really don't think you can do Chevron and Exxon without addressing that. I know Exxon is getting more and more into natural gas, which is a little bit more environmentally friendly than that. But these are issues that are becoming more prominent. I might put that Economist article. I'm collecting a bunch of Economist articles that I'll get to y'all eventually. And I might put that one in there. I thought it was an interesting article. They were talking about who the winners and losers will be long-term. And they really believe firms that are seriously making changes now will have a huge advantage in several years, but they could be wrong. It may be we never move. Everything governments do is lip service, and firms that move now may actually be wasting money. They may be helping the ecology, but they may be wasting stockholder money. But that's something to keep in mind. We'll talk more about that. Probably the most important part of all is the competitive position. And that's where we put in 2 things that you want to talk about that are related: sustainable, competitive, advantage, and economic moats. Those are the two things, they're related to each other. An economic moat gives you a sustainable competitive advantage. Definitely got to talk about that. So when I say competitive position in industry, I'm talking about, do they have some advantage? And by sustainable, that means no one can come in and copy them next year. So there's a few things here. We talked about this on our economic moat, so don't forget what we did there. A sustainable competitive advantage, first of all, means they have excess returns. They have positive economic value added. They're making higher returns than their cost of capital. Secondly, it's been there probably for a little while. It's not something they just got last year. And thirdly, they can probably defend it for 5 or more years. Usually when a firm is making excess returns, it attracts competition. New entrants come in, they try to compete with them, prices fall, margins shrink, and the competitive advantage goes away. So it's not just a matter of they have excess returns, they have excess returns and they can maintain that advantage. All right, so it's an extremely important part of this paper. That's what I mean by competitive position. So go back and look at that economic moats presentation. Think about, what I gave you all those different categories. Think about where your firm fits in there. Do they have that? Some of you have definite advantages, like an NVIDIA has that, what we talked about, the economies of scale of knowledge base. Some firms, I'm not so sure, like a Delta, Shamir, I think I seem to pick on airlines a lot. But what competitive advantage does Delta have? That's a really tough question to ask on airlines. ATVI, we talked in our session last week that they definitely have some branding advantages and they have some loyal followers, but how easy is it for someone else to come in and take that? So there's a lot to do there. That should be a big part of your paper. The next part may have some overlap with this because you're talking about strengths. So some of your strengths, if you wanted to incorporate those two together and make your sustainable competitive advantage be part of your strengths of your SWOT, it's up to you how you want to organize your paper. But a SWOT analysis, so if you go to MarketLine, MarketLine will provide a SWOT analysis for your company. You need to build your own, but they'll give you some ideas that you can look at. Some students do like a table in summarized form, and that's all they give me. What I like the best is the students to give a summarized table in bullet form of strengths, weaknesses, opportunities, threats. You'll see that in some of the student examples. And then they have a detailed discussion about each one of those after the table. That's not a bad way to organize it. Think back to the porters. What's going on in the industry? So the opportunities and threats tend to be more industry-like focused things. So if rivalry within the industry is an issue for you, that would be a threat. If you had a substitution issue, that would definitely be a threat. If there's something going on with suppliers or buyers that provide opportunities, there's things you can do. Opportunities can be taking existing products and putting them in new markets, taking existing products and finding new uses for them, or taking new products and giving them into your existing distribution system. Those are the kind of opportunities you're looking for. Strengths and weaknesses really do tie back to the competitive position, the sustainable competitive advantage, economic moats. What does this firm have that protects it from competitors? Where are the places where it's got weaknesses? Competitors can come in, can take over its market. All right, so have y'all done a SWOT before? Because I heard another term besides SWOT that I'm hearing more, and I can't remember what it is. I heard a few students say they saw it in their capstone class. Does anyone have an alternative to the term SWOT? Y'all know what I'm talking about? It doesn't sound like it. All right, so if you think if there is, I don't know if any of you have done your capstone yet, but there is a new term that's coming up. It's not one that I ever used in my career, so I should probably go out and research it more. SWOT to me is very straightforward, very simple, so that works well. This is a good place, again, to do the value chain management and supply chain management in Google for your company specifically, especially value chain management. Value chain management will definitely give you ideas on the sustainable competitive advantage and on the SWOT. So probably most of your firms, you can find a value chain management analysis somewhere out there on Google. I know someone said Ibis World does a supply chain management analysis in their work. I don't know if y'all have seen anyone do a value chain management in what our library provides. I've not seen it yet. I've never seen MarketLine do that. But I know if you Google it, you'll find some stuff like that. It'd be pretty useful for your company. And in some final conclusion, where do you see this firm's position? Where are they versus their peers? Is it sustainable? Is it really advantageous? Are they at risk? Be very, very, very careful here. I see this a lot. This happens a lot with these papers. Students become wedded to their company, and they feel like they have to argue their company's case. You've got to stay unbiased. You've got to, don't just quote management that we're the best in the business, we're really going to do it well. You've got to get a very, very honest opinion of what you think about your company. You're perfectly fine in this paper dissing your company, talking badly about your company. If that's what you believe, then definitely put that into your paper, all right? So that's the company analysis. I want to switch back to the class notes, unless anybody have any comments or questions up to there. Let me show you the example paper just really quickly before I do that. So this is the one on NVIDIA. Very good use of organization here. So very well organized. So company overview, just a little bit of definition of who they are, what products they provide. Company history, you can see he went on quite a bit on that, so it's a little lengthy for me. But especially NVIDIA is not that old of a company, but he did do a good job at least tying it back to where he's going next, the customers they have and the strengths that they have. So there's a little bit more in there besides just the company history. He kind of tied the company history into the products and customers that they have. He did spend some time on company culture. That makes a lot of sense to me for a firm like NVIDIA. Or a firm like ATVI makes a lot of sense. I think a lot of your firms have cultures. I know when I was at UTSA, there was a company culture, and it shifted as each CEO comes in, and that's an important consideration. CEOs tend to shift cultures to their liking, or they fail in shifting cultures to their liking. But if you're doing a Costco, your culture is going to be cheap. Everything's got to be cheap. You can't spend money. Everything's got to be as efficient as possible. That's got to be part of the culture. You can't have that kind of culture at NVIDIA. You're saying cheap, 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 let's cut labor costs. You can't do that. You've got to reward your employees extremely well because they're in your entire life of your company. Then he gets into the management side. He talks about the CEO. I don't like most of the management thing. I think there's just too much. So knowing where they went to school and all that, and just doesn't, that they're Fortune's Business Person of the Year. I want to hear their unique approach to managing this company. What have they said? What have they done that's unique? Do they do a lot of mergers and acquisitions? Is that part of their culture? Did they do that before they came to the company? Are they known as a cost cutter? Are they known as being expansionary, moving overseas? Try your best to try to figure that out. It's the tough part about this is finding that actual information. You might Google these people. Most CEOs of large companies, there's a lot written about them. You might try YouTube. One thing I think is really, really powerful, I should try this for a few companies, but go to YouTube and search on your CEO's name and see if you can find him or her actually doing a YouTube presentation. I don't think there's anything any more powerful than seeing a 30, 45-minute presentation by the CEO of your company. You're going to really get to see if they know what they're talking about, that they give you confidence, especially if it's question and answer. If it's question and answer, and anytime a technical question comes up, they step aside and let someone else answer it. That doesn't sound good to me. Are they excited? Are they excited about the company's future? Do they have big plans for changing this company? Some of your companies are in really, really tough industries, whether it's energy or airlines, or some of the consumer sectors. boy, hearing how the CEO is going to get you through this crisis and what their vision is their entire vision just survival, or do they actually want to make this company better? So do more. I really don't like, I mean, this is a good paper, but I don't like this part where they just tell me, hey, you went to SMU. Well, why do I care about that? That doesn't help me. Now, fortunately, I only did 2 of them. I've had some students do 5 or 6 of their management team. And then he got into strategy, extremely important. The sectors and customers, key products. So he's doing all those things. I'm not saying you have to do all of those. Competitive position, I like the term more competitive strategy, sustainable competitive advantage, those kind of things. But that's where you put your economic moat in. And then the SWOT analysis at the end. He broke it into one paragraph for each strength. He didn't do a table summary. And then his concluding thoughts, which are pretty short, but next 5 to 10 years are important because autonomous vehicles. All right, so he tells his boss, a key for NVIDIA is going to be autonomous vehicles. Well, that's really powerful to tell your boss that that's a key to this company surviving. All right, so I like this paper, and it's one that was written just this last year, so it's a good test case that he's using the more current template. All right, let me go to the class notes. I want to talk a little bit about this ESG and management. So I'm in the class notes on page, I should have numbered the pages. I don't know what page this is. 11. Page 11, company and management analysis. So corporate governance. What I did on corporate governance is Dr. Demadaran, one of his graduate level classes, he spent a class or 2 talking corporate governance. So I just stole stuff from him because it's not something I've spent a lot of time in my career on. I do think it's critically important. It's just when I was a security analyst, we just did not have access to information like you do today, so it was much more difficult. I don't know if you know Demadaran. I gave you 2 of his videos to watch. Once you get paper 1 and 2 done, strongly recommend you watch his videos. Those videos will help you tremendously with paper 3 and how to think about your company. He gives a lot of examples. I don't think he gives examples of any companies you are doing, unfortunately. He might talk Netflix in one of them. He does talk about Amazon. But he talks about Uber quite a bit. But he gives you an idea how to handle your company. I really love his presentation on life cycles of products. He talks about, and this really ties back to management, and that when you see that particular video, he says firms have life cycles just like humans. There's teenage companies, there are mid-20s companies, there are 40-year-olds, in the 40s, kind of. As an example, I don't mean they're 40 years old, but they're like 40-year-old men or women, and they're senior citizens. And he says the worst thing you can do for a senior citizen product is to hire a teenager to run it. And the worst thing you can do for a teenage company is to hire a senior citizen to run it. He talks about how you line up the culture and the personality of the CEO with the life cycle of your company. Really good presentation. He gives a lot of really good examples. So he's a really sharp guy. I like a lot of what he does. So what he asks first is a good question to ask under management is, where is their priority? Is their priority maximizing shareholder value, or do they have something else? So someone's doing Procter & Gamble. Unilever is their main competitor. Unilever is a big ESG company. They talk a lot about the economy, ecology, and social impacts, and those type of things. Is that what you want them to say? I know there's been a lot of debate about Milton Friedman and stockholder value is the most important thing, but Demadaran makes an interesting point. Maximizing stockholder value doesn't mean that you dump on your employees and your customers and your suppliers. What it means is you still got to treat your employees extremely well. You still got to treat your customers extremely well, but you're always thinking about the value to the stockholder. He followed a presentation once where the person before him said, customer satisfaction is the most important thing to a firm. It's not stockholder value, it's customer satisfaction. And he said, well, that's easy. Just cut all your prices 90%. Your customers will be really, really happy. But they won't really be that happy long-term because you go out of business. And so if you put customer satisfaction first, you destroy the company. If you put stockholder value first, the company stays around and your customers are really happy, because the only way to maximize stockholder value is to make the customer extremely happy. So he says there's no conflict here. I think even Milton Friedman might even say something similar. He might be a little more stark. I don't think there's that much of a contradiction or conflict. If you're treated like Amazon's having so much trouble with its employees right now, Uber's having trouble with its employees right now because of what's going on in California. If you don't get that right, you're not going to maximize stockholder value. So if management does not always put stockholder value top priority, the worst case is they're managing their own interests first. They have golden parachutes. They have stock option plans that win. If the firm does well, they win. If the firm does terribly, they still win. So what is management incentives? Are management incentives aligned with the stockholders? Look at the board of directors. This is something we never did when I was a security analyst, because when I was a security analyst, board of directors were rubber stamped. Whatever the CEO wanted, they just said yes. They got paid a lot of money to do nothing more than just say yes, whatever you want. That has changed. Boards have become much more activist. You should really think about your board and who is on the board. Are they independent? There was a time where a previous CEO of Disney, the chairman of the board was the Disney CEO, and a key board member was the CEO's personal lawyer. That's not good. That's a conflict of interest. So you want an independent board. When I was at USAA on the mutual fund side, our board was independent, except for our CEO was the board chairman. And he got really mad anytime the board told him to do something. He would just say, no, we got that. That's our part. That's our responsibility. That's not yours. He did not like the board telling him to do anything. At USAA level, USAA, when it was managed by Bob Davis, he actually wanted the board to be active. It was interesting. He went to the board and he was convincing them to make changes. He wanted their approval. He wanted their input. It's a very, very interesting approach. So it depends on the company. You might ask, is the CEO of your company the chairman of your board? Or is it an independent board? I'm not sure any boards are really independent. I think my opinion, one of the reasons CEOs are paid so much now is the CEO of one company is on the board of another company. And they know if they're on a board of a company, if they know they've got to vote for a really huge CEO pay package, because another CEO is on the board of his company and he wants them to vote for a large CEO package. And I think it's just kind of gotten run out of control. So ask those kind of questions. How active is the board? Some of you, and we'll talk about this, some of you have boards where you have an activist stockholder that's coming in, buying up 5, 10, 15, 20% of the business, and is actually trying to stack the board in order to get rid of management and change the company. You should ask, are there activist stockholders that are coming after your company to make changes? Even with independent boards, the CEO still has an information advantage. They have control over what goes to the board. I know when I was a portfolio manager, we went to the mutual fund board meetings. They were given this humongous notebook of data, and I could just tell they hadn't read it. They're getting paid, $50,000, $60,000 a year to go to 4 meetings. They should read all the material, but they just don't. One of the board members, boy, she was really smart. She went in, I think, randomly and read 1 page in detail, and then she asked a question about that 1 page, just so it looked like she'd studied the materials, and then she was quiet the rest of the meeting. Well, that's fine. The problem is, if you're on the board and they go under, you're going to be sued. And so that was the one time the board paid attention, is when they talked about the insurance policy on the board members for errors and omissions. It's like, wait, is that enough? Can we get more? So there are a lot of still rubber stamp boards out there. So you need to ask that question. Read the company's SEC 14DEF. Talking about conflicts of interest between management and the board. Capital IQ supposedly has something. I've never used it. Yahoo Finance might have something. So there are places out there that will actually grade companies and boards on governance. For whom does the board work? Does it work for management or for the stockholder? You want a company whose board works for the stockholders. Evidence of board working for management would be things like green mail, golden parachutes, poison pills, all those things that say, if we change management, we're gonna devastate this company. That's not a good sign that the board has the stockholders' interest. If management is doing a lot of mergers and acquisitions, driven almost entirely by the CEO's ego, that's a bad sign for governance. So where does the power lie? Does the power lie with the stockholders, with management, with inside stockholders? There are still companies like Walmart, like Disney, that have people with last names like Walmart, like Walton, like Ford, like Disney. Disney has a board member named Disney, right? Do we have anyone doing Disney? Boy, I can't remember. I don't think we do we? So yeah, but Disney now has a Disney, and he's pretty activist. There's a Ford on the Ford board who was pretty outspoken. So there's still around. I don't think the Waltons are, it's getting pretty diverse every generation. There's still a bunch of them around. Some of y'all may have a founder still involved. I'm not so sure about that. Boy, I don't know about Netflix or ATVI, but that's often a really bad sign. If the founder of the company is still heavily involved in the company. Founders are usually great founders and terrible managers, and so that's a concern. Maybe Steve Jobs is the exception, but and you might also ask, who are your major stockholders? This is really easy information to get. It's easy to get out of Bloomberg machine. Most companies, their top stockholders are going to be institutional investors. So BlackRock, oh man, I've forgotten. BlackRock, State Street, Vanguard, Fidelity, the large institutional mutual funds, they're going to be the largest investors. The negative side of institutional investors is they don't have time. They're not going to stay and fight. So if a firm has bad management, institutional investors, they just get out and go buy another company. So institutional investors do not change companies. They just sell them and go somewhere else. Now, CalPERS and some of the others, they're becoming more kind of intrusive, but mainly on the ES, on the environmental and social side of it, not so much on fixing the company. Self-holdings, companies on pension plans, that's not a good sign, right? Because then the company management has control over those. There are some where there's governmental influences. So that could be important. Different voting rights. Boy, I'm noticing this. Netflix, I forget who's doing Netflix, but in the media industry, you'll see multiple share classes. You'll see the same ticker, A, B, and C, and I've even seen more than that. It's amazing. I don't know why in that particular industry there's a lot of subclasses. Google has subclasses. Google has subclasses because, in Google's opinion, stockholders, we don't need your help. We'll run this company ourselves. So we'll have shares where we have more control, and we'll give you shares where you don't have as much power. I don't think that's a good sign for Google. It kind of makes me nervous. We own Google stock for quite a while in our student portfolio, but I didn't like that. We had actually one share of each. We had the A and B share, but you might look and see, does your firm have different voting rights? Family group companies, do you still have family members that have large holdings of your company? Corporate cross holdings is not a big issue in the United States. It's a huge issue in places like Germany and Japan, where company A owns 40% of company B and company B owns 30% of company A. Some people think in Japan that's one reason why there's some firms that really are insolvent, but they won't go out of business. They won't go bankrupt. They just keep hanging around because of this cross holdings. I don't think you'll see much of that in the United States. So maybe the best sign for your company is you have an activist investor, someone coming in and buying 5–10% of the shares. It kind of depends. I've had some investors where their firm got bought out or got transitioned and they were really upset about it. They didn't like what the activists were doing. So it kind of depends. You probably have heard of some of the big activist investors. They're still out there. I don't know if any of your firms that you're doing has a major activist investor involved, but you might look into it and just see what's going on. For some of those SEC filings really help. If someone buys 5% or more of a company, they have to file with the SEC to say that's going on. You may have to go quite a ways down the list because you might have 7 or 8 institutional investors in your top 10. Look through and see what management owns in shares. Does the CEO and CFO own a substantial part of the company? That can be good or bad. Obviously, if they own a lot of shares in the company, you would think they'd be aligned with the stockholders. But it may also mean that they're protecting themselves from being replaced if they're bad managers. All right, so make an attempt at this. You will notice many of the prior papers don't do this at all, but a few of the more recent ones have been trying for it. I'll definitely give you extra points if you make an attempt at this. This is a good way to get extra critical thinking points on the paper. So I would at least attempt it. You could probably just Google who are the major stockholders of Netflix and just see what comes up. But I do know Bloomberg will give you a detailed list of all the stockholders. All right, so we talked about this. What should management's goal be? And what Darren says is maximize stock price. Why does he say that? Well, if you maximize earnings by doing things that are actually going to kill you long term because you're taking on business you shouldn't take on. It's business that's really risky. That's not so good. Maximizing revenue doesn't make sense if you're going to destroy your margins. Maximizing firm size, a lot of CEOs, that's actually their goal, make the firm as big as possible. But that may actually make you a target for regulators, and it might actually make you less profitable. Maximizing market share is just like maximizing revenue. And at the same time, it makes you susceptible to antitrust. The ultimate answer is this last one, no question, maximizing economic value added. That's what you really should be doing. That's what you want management to do. If you see your management talking about economic value added, that's a really good sign. That's the #1 thing you should be doing for stockholders. But the reason you as a stockholder don't like that is because it's an extremely subjective number. It's really, really hard to measure. There's a lot of debate exactly how you measure, especially the return on invested capital. How do you measure the economic value added? You can get the number out of Bloomberg. It's no trouble, but it's Bloomberg's computation. It's not, their calculation. It's the way they decided to calculate it, which may not be the way you'd want to calculate it. So what Darren says is just maximize the stock price, and you're probably maximizing everything else, including the vendors, the employees, the customers. Everything else is maximized if you get the stock price as high as possible. Could the stock market be wrong? Yeah, they could be wrong. However, you're getting information every second of the day. They tend to correct themselves pretty quickly, especially when new information comes out. Versus anything else, it's probably your best indication of what's going on with the company. There's an interesting analysis out there of when the shuttle disaster happened, a horrible event. But I don't know if y'all have read the paper on how the stock market reacted to that. The initial findings was blaming the wrong companies for the accident. And yet, if you looked at the stock market got it exactly right which company was at fault and which stock price should be going down. It was amazing how much insight the stock market actually figured that kind of thing. The stock market is actually quite brilliant, mainly because this large group here, these institutional investors, these are smart people. They know their companies extremely well, and they move quickly when these kind of things happen. And I know the retail investors out there buying at the worst possible time and selling at the worst possible time, but they don't drive stock markets. It's the institutional investors and activist investors that drive stock markets, and they know these companies extremely well. So I don't think that's a bad way to think about it. Maximizing stock price It's a good way to think about it. You do want management talking about EVA, but you want them talking about EVA because they want to maximize stock price. CalPERS does do a governance, but I actually checked this website and it doesn't look like it works anymore. So I would recommend try Bloomberg, try Yahoo Finance, or try Capital IQ to get an ESG type of report. Boards are supposed to be becoming more independent. One thing that they're doing is they're shrinking the board, so it's not, you know, so many people, so it's so diverse. There are fewer insiders on boards. Now, USAA had an independent board. It was mainly people coming from the military, but very independent. I had interactions with some of them, and boy, they could definitely make the CEO's life very miserable. They definitely could speak up. They weren't technically knowledgeable as you would hope they would be, and that's something you might want to think about. If you're doing Exxon and your board is made up a bunch of CEOs from retail, that's a really difficult industry. How well do they understand that industry? I don't think it's an issue if, you know, if an Exxon CEO is on a board of Kohl's, I don't think that's that big of a deal. But having the CEO of Kohl's on the board of Exxon, I think that's an issue. That's a very difficult company to understand. Directors are more increasingly compensated with stock options to try to align them with the stockholders. And more directors are being selected by independent nominating committees rather than by the CEO. I'd love to get on a board. I think, you know, I don't want to be sued for being on the board, but to me, getting paid, you know, $150,000 or whatever a year to go to a couple of meetings for a firm that's AA rated, I think, yeah, I'd probably be okay with that. I'd have to do the job. I'd have to work on it. When Dr. Misra was at UTSA, I kept telling him, boy, you should get on the USAA board. You'd be perfect, especially USA's mutual fund board. And he said, yeah, I'd do it. It'd be really interesting to do. He would have been great on that board. USA's mutual fund board was, for the most part, people with kind of a general idea about business. And then my last year there, they hired a finance professor from Rice. And she came in and she dominated that board. She asked a lot of good questions. She was actually the professor that created the VIX, the volatility index. So I was really amazed to meet her. She sent me all kinds of really cool stuff. It was really amazing to meet her and talk to her about what they did. A pretty famous person. So, but she had a tough time getting the CEO to actually, you know, she was asking more questions for a knowledge base. Versus really trying to change the company. But once you learned the company, I bet she became a pretty tough CEO, board member. So think about that. Who's on the board? Who are these people? What's their background? Do realize they don't meet that often, so it is somewhat of a limited interaction, but they do have a lot of personal liability to get it right. All right, so there's your paper one. I know you don't want to think about paper one right now. You want to wait until Saturday to really get into it. But look back through this rubric and tell me what's the part of this paper that you're the most uncertain about. It doesn't look as intimidating as paper one, does it? It's a little more straightforward. So, and if you look at the example student papers, you can see most of them have too much trouble. Be careful of the copying and pasting here. So if you find something, put it into your own words, or if you need a quote. I do think it's really powerful. You don't see it much in the papers. It's really powerful to quote the CEO and hear what their vision for the company is. That's why I say really try to find some videos. One thing, I might try it, you know, the next couple of days. I've tried before and I've had some success. Investment conferences are the best. I love them. I loved going to them when I was an analyst, not just because it's a free trip and you get all kinds of free stuff. But CEOs speak at investment conferences. Some of these investment conferences are online. I know I saw UBS, which is a major bank. They did an energy. So three of y'all doing Exxon, Chevron, and Valero. I have to look for this, but UBS has a Texas investment conference. And I think as bad as COVID is, COVID might be a huge benefit to us because you know all these investment conferences have gone online, they've gone digital. And a lot of these are probably available for free online. So I'll have to go look, but that's something to do. All you got to do is type in maybe UBS Energy Conference or Fidelity or JP Morgan Retail Investment Conference and see what comes up, maybe in YouTube, maybe just online. I'll do a little experimenting with that. If you can find that, then they will have the CEOs of these major companies. And maybe the CEO of your company is not speaking, but maybe the CEO of a major competitor is. And I think you're going to find that really helpful. Another thing you could do that I don't have in here, I don't know if y'all have ever done this, is the earnings calls. Have any of y'all listened to an earnings call? You can usually find that on your firm's webpage and see if you can hear, what is the CEO talking about? What are the analysts asking about? What are they most concerned about? And how does the CEO respond to those questions? This could be incredibly huge, especially for your energy companies, given how badly energy has been doing this last year. Be really, really, really huge. Netflix, Netflix has a problem with, my word, they're spending billions of dollars on these production. I'm sure the analysts are going to ask, when are you going to monetize this? When are we going to see it in a huge growth in membership? What happens when you saturate membership and you're still spending billions? Those are the kind of questions you're going to ask. So you're listening for a couple of things. First, the overview of the CEO. What are they saying is the key for this firm? What are the analysts asking, and then how does the CEO respond to the analysts? Some of these conference calls are an hour, but if I were you, you can usually get the transcript of the call, and then you can skim through, and you don't have to. A lot of it's really boring stuff. Where the CFO is going through, why did accounts receivable go up 12% this year? It's just stuff that's just so minutia. It might be helpful for paper 4, but not for paper 3. So try to get some quotes from your management. It really will strengthen your paper quite a bit. All right, so I know some of you are like, I can't even think about it. Start working on it. Some of y'all, I think last week, could see why I kept saying, make sure you spend time on your paper every single week. Don't let this bunch up on you. And so a lot of y'all kind of the first 3 weeks, you let them go by, and then suddenly you had to write a paper really fast. So spread it out. All right, so we're in about an hour here. Where we're going next, paper 4 is the most straightforward, and this is the model we're going to use for paper 4. And I'm going to give you very, very precise on this one. So next class, this is really, really important next class. I'm going to type it here. It doesn't really belong here, but I'm going to type it here. You need to have 2 things going at the same time. You need to have the Excel for your company open. All right. So each of y'all know where that Excel is for your company. It's under, you probably already looked at it. Have that file open, and then you need to have the Word for Walmart open. Have any of y'all, let's see, let me look at this class. Any of y'all have me for a 3013? I don't think so. I don't recognize anyone. Maybe it's a bad sign. People don't ever take me twice. I have a lot of double in some of my classes, but not in this one. Yeah, 3013, I use the same model there, so you already have some familiarity with it. The reason I'm using this model is I've discovered a lot of finance students are really uncomfortable doing a financial analysis of a company, and it's the most basic thing you need to do. So what I'm going to do is give you a template that is a very good template. Trust me. It's a template. Actually, I had a student get an intern at Citibank, and they had this team competition, and it was to do a financial analysis, and no one knew what to do on his team or in any team. They were all clueless. And he said, well, I had this professor to give us template. Why don't we use it? And they used the template and end up winning the competition. It's a good template. Trust me. If you get into your first job and you need to do a financial analysis, you can use this template and they'll be very impressed. So it's a very good template. I've had a couple of students that refuse to use the template and they got a really low score. They didn't get a low score because they didn't use the template. They got a low score because the financial analysis was really bad. It was all over the place. It wasn't organized. They did things like current ratios. I don't know if you know finance, we don't use the current ratio. We don't use the asset test ratio. There's things we don't do in finance that they teach in accounting. You don't want to use those ratios. We don't use debt to equity in finance. So there's a lot of things they teach in academia that we don't use in practice. And so I want you to use the template. Now, what you can do if you don't like the template is you follow the template and then you add the stuff you want to add on top of it. That's perfectly fine. But follow the template, all right? Hopefully everybody understands that. I'll probably repeat that several times in the next class. Follow the template. So, all right, it's been about an hour. So any questions on anything? So the paper's due Friday. It'd be nice if I have 4 or 5 of them done, say Friday by 6, so I can grade 4 or 5, but we'll see. How fast I get them back to you depends entirely on how many I get at what point in time. If I get, 30, 40 papers Monday night, I won't have them graded. So, and then I may never get them graded because I have another paper coming in from another class right after that. So I need a lot of y'all to get your papers in this weekend. It's not to your advantage to turn them in late because that's just going to put you further behind on papers 3, 4, and 5. So don't let that happen. All right, I'll stick around if y'all have questions until everybody gets off. But we're done. I'll put the YouTube of this out there sometime probably tomorrow.